Good evening to all. This is the day 7 of special lecture series program for undergraduate students organized by Kolkata Bidhannagar Society for Academic Advancement, Bengal, India. Today's topic of discussion is leverage. Today, Arijit Banerjee sir is with us. He is state-aided college teacher grade 1, Department of Commerce, SHIBPUR Dinobundhoo Institution, West Bengal, India. Over to you, sir.
Thank you. Uh, Today I am going to start with the leverage, one of the important chapter of financial leverage. Am I audible to all of you?
Yes,
Am I
sir.
audible? Okay.
Yes, sir.
Uh, okay. Leverage is a very important chapter in financial management. So I am starting with my presentation and with the topics of leverage. Now, uh, I am starting with the word leverage. What do you mean by leverage? Basically, you hear the term or you learn the lever in class 8 or class 9. Lever means in science, in physical science, you hear that lever. What is lever? Lever means you made some force in one side and you get the result in a better way on the other side. Example, when you are uh, pull up some water from the well, you use the one type of lever. That means you are putting less effort, and on the other side, you are pull out the bucket of water in a very easy way. So that is the meaning of leverage. So in financial leverage is also the same. That means influence of power. Basically, leverage means influence of power. In financial leverage means influence of an independent financial variable over a dependent variable, and you make some less effort in one side and you get some greater earning or greater earning per share from the other side. That is called the leverage. For example, we know the financial leverage. In case of financial leverage, we means that if debt is more in your capital structure, then if you increase little in the EBIT, you get more return in the EPS. That is called the leverage. That means you put some variable on one side and you get the more result on the independent side. Basically, leverage means the degree of risk. So high degree of leverage means high degree of risk. So we are going on the risk. What is actual on the topics leverage? Also, risk is sometimes cover of the chapter of risk. What is risk? Risk basically is a degree of uncertainty, or you can also say that risk is basically deviation from your expected result. You, if you know that everything what will happening to you, then there is no risk. You know, I am doing the 10 sums in your in examination. Suppose you think that I am doing the same 10 sums and you know that that sums are right, and each sum is carry 50 marks, then you know that I will get 50 marks. There is no risk on this thinking, that you know that I will get 50 marks. There is no risk because there is no deviation from the result. You get all the, you know, all the certainty. But you do the 10 sums at the rate of 5 each, and you know there 8 is correct and other 2 is some doubt on that 2. That means you are in risk. That means on 2 sums you have some uncertainty. That is called a degree of risk. So
Hello, sir.
yes.
Can you please hide the Google Meet, the written stop sharing and Google Meet? No, not this. Just hide it,
Okay,
this
okay,
notification,
okay,
because
okay,
this is blocking the PPT.
okay, okay, okay. Thank
Okay, sir.
you. Now,
Okay, sir.
so so that is the risk. That means you have some uncertainty of your future outcome. That is called the risk. When, and also the deviation from the result. You invest some money in a bank fixed deposit. You know that after the year you will get 7.5% interest rate. There is no risk because there is no deviation from your result. It is risk free because, but If you same amount of money you invest in the shares in the mutual fund, then you do not know that what is the expected rate, expected result you are earned. That means what you are expected, maybe you get the high, maybe you get the low. That is deviation from your result. That is called the risk. In finance, risk is mainly two types. One is called systematic risk and unsystematic risk. Systematic risk means that the risk for the all the system, that is called systematic risk. Example, when there is a COVID situation, when there is a COVID situation will arise, every firm, every organization is going to the risk. That is called the systematic risk. Suppose there is a war between Ukraine and Russia, all the firms are going in somehow in the risk. That is called a systematic risk. That is not come to your organization only. That risk is going to all the organization. That is called a systematic risk. And what is the unsystematic risk? That means that risk is only for your organization. That means your organization is only under risk. That is what you are expected from the result, what is the expected result. You are deviated from your expected result from your organization only, not from all the other organization. That is called the unsystematic risk. In the COVID situation, all the firms had some uncertainty. How much they are get the profit, what will be the return, what will be the sales amount. All the firms in its question marks. That is called a systematic risk. But suppose for any reason your firm is not going up to the marks, not going up to the sales, not going up to the rate of return, that is a problem of your firm only. That is called the unsystematic risk. You know, in the cost of capital structure, systematic risk can be minimized by the systematic risk cannot be minimized, but unsystematic can be minimized. Unsystematic risk can be minimized by portfolio deviation. If you purchase various shares or various companies, your unsystematic risk is minimized, but it never going to be zero. But in systematic risk, systematic risk cannot be zero at any time. And systematic risk is measured by the capital asset pricing method. Now we are talking about the unsystematic risk. There are two types of unsystematic risk. One is called business risk and another is called finance risk. Next, what is business risk? Business risk means risk associated with the operation of the firm. That means what you have expected sales, you do not get the amount of expected sales. You do not, what your sales price you decided, people are not purchased on that sales price. You do not get the expected rate of return. That is only associated to your business, but your rival business, your competitor is doing well. So your business is under the risk. That risk is called the business risk. That means risk associated with the operation of the firm. And also business risk arises out of fluctuation of the rate of return. There are three types of business risk caused. One is economic specific factor. Economy is some way that your rate of return is not coming in expected way. There is industry specific factor. Your industry going downward. Suppose before 10 years or 12 years, you are entered into the cassette industry. You are making the CD. Now, after few years, that CD making industry is going abolished. So your business is also come under the risk. That is called the industry specific factor. And third one is the company specific factor. That particular your company is not doing the well. That is a company specific factor. First one is economic specific factor. Total economy is going down. In 2008, we know that total economy is in demoralized. That is the economic specific factor. Second, I am giving the example of cassette player, CD player. That is the industry specific factor. And third one is the particular for your company only. That is called the company specific factor. So business risk is arise due to variability of EBIT as a result of environment in which a company operates. That what EBIT you are expected, that means what earning you are expected from the business, that is not coming as you wish. So that is called a business risk. So business risk, EBIT as a result of environment in which a company operates. Maybe that is the business risk is due to sales price is going down, sales quantity is going down. That means your earning is going down. That is totally related to the EBIT. Next, we coming in the financial risk. Financial risk means risk associated with the financing decision of the firm. That means you are not able to pay the fixed commitments or contractual obligation. Contractual obligation or fixed commitment means that you have taken some debt from the parties and you are not able to pay the debt. That is called a financial risk. You are taking some debt, long-term loan, and you are not able to pay that interest amount to that party. That means you are coming in the financial risk. So we are saying that financial risk arises out of possibility of failing to meet fixed commitments or contractual obligation. Similarly, possibility of fluctuation in income available to owners' equity. That means what you expected earning per share, you do not get the same returns on the earning per share. That is in fluctuation. This is called the financial risk. There are some important theory that what is the difference between business risk and financial risk. First of all, business risk is associated with the operation of the firm, and financing risk is associated with the financing decision of the firm. Business risk cannot never be zero, but financing risk can be zero. How? If you make no debt, you do not take any debt from any outsider, then your financial risk is zero because you did not pay to anyone, then your financial risk is zero, but business risk cannot never be zero. Again, business risk arises out of fluctuation of rate of return in total fund investment, and financing risk arises out of possibility of failing to meet contractual obligation. I said that you are not able to pay the interest to the third party, then the financial risk will arise, and influenced by cost structure of the firm, and financial risk is influenced by the capital structure of the firm. Now, I am saying some words. There is a two words: capital structure and financial structure. There is a difference between capital structure and financial structure. Capital structure means only debt and equity. No current liabilities is included in the capital structure. But when we call the capital structure, financial structure means all the liability side of the balance sheet is come under the financial structure. So remember the difference between capital structure and financial structure. Capital structure is only the debt and equity. No current liabilities is included in the capital structure. But when you say about the financial structure, that is different between capital structure and financial structure. In case of financial structure, no current liabilities, only the debt and equity is not. Also, the current liabilities is included in the financial structure. That means all the total of the liability side is come under the financial structure. Business risk cannot be fully avoided. Obviously, there is some business risk. You may not be your sales, may not be your expected according to expectation, may not be sales price according to expectation, may not be you are earning the EBIT. Your operating cost may be high. You do not earn revenue as you expected. So business risk can never be zero. You cannot be. It can be reduced, but you cannot fully avoid it. There will be some business risk, but finance risk is completely avoided. I am told that finance risk can be zero by you do not take debt from any outsider, then your financial risk will be zero. So that is the business risk and financial risk. Why we come in the risk chapter? Because business risk is associated with the operating leverage and financial risk is associated with the financial leverage. That before we starting with the leverage, we have some discussion about the what is business risk and financial risk. And another one thing, business risk is always more than the financial risk. Because what is business risk means? Business risk means that your rate of return is not according to expectation. That means what your expected rate of return, you do not get that amount of expected return, or you are incurring loss. That is called a business risk. Now, what is the financial risk? Financial risk is you are unable to pay the interest to the outsider. So suppose you are in business risk, that means you do not get the income, you are making the loss. So when you are going the loss, obviously you cannot pay the interest to the outsider because you are incurring loss. Then if you incurring loss, how you pay the interest to the third party? That's why business risk is more important than the financial risk. Similarly, operating leverage is more important than due to financial leverage, that I am coming in the next way. So this is basically business risk and financial risk. Now we come in the topics leverage. I have leverage means I have told that putting some efforts in one side and I am getting more effort or more return from the other side. That is called the leverage. There are three types of leverage in your chapter, in your syllabus generally: operating leverage, financial leverage, and combined leverage. Now, we are starting with the operating leverage. What is operating leverage means? Before going on a definition, I am simply saying that suppose you are want to going a Xerox business. You think that I will purchase a Xerox machine and I am doing the business. You and your friend. Now, you have a huge capital in your hand. So what will you do? You can purchase a new machine, and your friend has less capital in his hand. He has purchased the old machine. So you are investing more on the fixed asset and your friend is investing less in the fixed asset. When you are purchase a new Xerox machine, obviously you are expected that your power consumption, ink consumption, cartridge consumption is less because you are purchasing a new first-hand machine, the new brand machine of the and it is high price. Similarly, when your friend is purchasing a second-hand machine, their power consumption, ink consumption, cartridge consumption is more because he has purchased second-hand machine. So what we are saying that when you are investing more in the fixed operating cost, that is in fixed costs, your variable cost is low. And when your variable cost is low, and what is your in case of friend? He is investing low fixed cost, but your variable cost is high. So which fixed operating cost is high? John, when fixed operating cost is high, we say that operating leverage is also be high. And when fixed operating cost is low, that means there is also a low variable cost. That means we are saying that the operating leverage is low. This is the thing. Operating leverage based on cost structure of a firm. We use the high technology, that means high fixed cost and low variable cost. And as a low variable cost, there is a high operating leverage. High operating leverage means, what is the high operating leverage means? That is that I come later. First, we're going on a definition. So that is the basic idea of the operating leverage. So basically, operating idea leverage means you have high fixed cost and your operating leverage will be high. And similarly, you have low fixed cost, your operating leverage is low. So definition of operating leverage is the firm's ability to use fixed operating costs to magnify the effects of changes in sales on its earning before interest and tax, or EBIT. That means you put some effort. If you increase, if your operating leverage is high, that means if you increase your sale in a low portion, your EBIT will be increased in a greater portion. That is the operating leverage. So operating leverage is the proportionate change in EBIT and proportionate change in sales. Now I am going to show how this there are two formula in the operating leverage. One is proportionate change in EBIT and other is one is called the proportionate change in sales. Now I am showing that operating how this proportionate change in EBIT and proportionate change in sales, from this formula how you derive that operating leverage is the contribution by EBIT or contribution by operating profits. Operating profits means the EBIT. Similarly, you are all the commerce students. So remember one thing, operating profit is not the net profit. Operating profit is the EBIT, earning before interest and tax. With interest, earning before interest and tax, with operating profit, you add the other income, then you get the net profit. Okay. So operating profit plus other income minus other expenses, other non-operating income minus non-operating expenses, then you get the net profit. Now, I am deriving this. Okay, there is okay. Hope you will see all the whiteboard. Now we are studying what is the degree of operating leverage. We says that proportionate change in EBIT divided by proportionate change in sales. In further way, in case of sales, we have says that sales means Q. We have derived that sales is equal to Q. No, proportionate change in sales means del EBIT is change in EBIT and del sales by sales. This is the proportionate change. This is the proportionate change in EBIT, and this is the proportionate change in sales. So we can write from this here del EBIT is equal to del Q and Q by EBIT. We can write from this way that Q is going up numerator and del Q is coming in the denominator. So del EBIT by del Q, we write del EBIT by del Q, and when Q is going upward, Q by EBIT. Now, what do you mean by EBIT? How you derive the EBIT? EBIT is equal to sales minus variable cost that is contribution into quantity, that is we get a contribution minus fixed cost. We can write that way. That is the EBIT. Sales minus variable cost, contribution into quantity, we get a total quantity minus fixed cost, we get the EBIT. That is contribution plus fixed cost is equal to EBIT. Now differentiate with respect to Q. So when we differentiate in EBIT, we get del EBIT and del Q. Actually, it is right by D. I am writing the del because we can find this one from this formula. That's why I am writing del EBIT by del Q. Now differentiate with respect to Q. So this one is S minus V. Q means 1. That means what is the differentiate of 4x? That is 4. Same thing, 4Q. So what is the differentiate of 4Q? That is the 4. So assume this is 4Q. So S minus V and fixed cost is differentiate is 0. So we can write del EBIT by del Q is equal to S minus V. Now we put that del EBIT by del Q, we put that amount in this side. That now we are writing EBIT by del Q S minus V into Q by EBIT. Just put that del EBIT is equal del EBIT by del Q. Just put the value of del EBIT by del Q, that is S minus V. Now S minus V into Q, that means again S minus V minus Q. I have told you that is the contribution. S minus V is equal to contribution by EBIT. So we can write that degree of operating leverage proportionate change in EBIT and proportionate change in sales. Similarly, we can write it contribution by EBIT. Clear? We can also write it contribution by EBIT. Now, what is the contribution means? In contribution, we can write that EBIT plus fixed cost. We can write in this way because contribution plus fixed cost is equal to EBIT. So EBIT plus fixed cost is the contribution divided by EBIT. This is nothing. EBIT by EBIT 1 plus fixed cost by EBIT. So we get the three formulas of degree of operating leverage. All are almost same. One is proportionate change in EBIT by proportionate change in sales. Number 2, contribution by EBIT. And number 3, 1 plus fixed cost by EBIT. Now I am again going my slide. That is the same thing I have repeated. Degree of operating leverage, that is proportionate change in EBIT by proportionate change in sales. So operating leverage is defined as the use of fixed operating cost to magnify a change in profits relative to a given change in sales. We can write operating leverage is contribution by EBIT. Also, we can write that EBIT means contribution by fixed cost. So we can write the contribution by fixed cost. Also, we can write 1 plus contribution by 1 plus fixed cost by EBIT. That can also be right. Now, what is the characteristics of operating leverage? First two characteristics I have already discussed. Operating leverage based on cost structure of a firm. Second one, high technology means high fixed cost and low variable cost. So high operating leverage. Now I says to you that operating leverage 5. What does it mean? It means 1% increase in sales, 5% increase in EBIT. That is the degree of operating leverage means. Degree of operating leverage 5 means 1% increase. If you 1%, there is a 1% increase in sales, your operating profit or EBIT will increase by 5%. Of degree of operating leverage 2 means if there is a 1% increase in sales, that means there is 2% increase in EBIT. Can you tell me one thing? Whether degree of operating leverage can be negative any time? Degree of operating leverage can be negative at any time? No, because what is the minimum degree of when there is no degree of operating leverage, when there is no fixed cost in the capital structure in your business, then there is no degree of operating leverage. If there is no fixed cost, there is no degree of operating leverage. Your fixed cost cannot be negative. Minimum fixed cost is 0. So that means minimum degree of operating leverage is 1. That means no operating leverage, but degree of operating leverage can never be 0. Okay. Now we are coming in the relation between degree of operating leverage and market and margin of safety. Margin of safety means actual sales by break-even point sales. We know it is from a CBP analysis. Margin of safety is equal to actual sales minus break-even point sales, and margin of safety ratio is equal to margin of safety by sales. That is called the margin of safety. Actual is MOS ratio is equal to 1 by DOL. That means it is inverse relation. Margin of safety ratio and degree of operating leverage is an inverse relation. How this leverage ratio is come, I am showing to you. No, we are starting with the margin of safety. Margin of safety ratio means I have told to you that margin of safety by sales, that is the margin of safety ratio. Degree of operating leverage is actually inverse to the margin of safety ratio. So margin of safety by sales. Margin of safety means actual sales minus break-even point sales by this is also the actual sales. So from this one, I can write sales by sales. So 1 minus break-even point sales by sales. Again, what is the break-even point formula? Break-even point formula is fixed cost by PV ratio. You know that is from cost volume profit analysis. Break-even point sales means fixed cost by PV ratio, and similarly it is by sales. Now 1 minus PV ratio means nothing but contribution by sales. PV ratio is nothing but contribution by sales. Similarly, this sales and this sales is set off. So 1 minus fixed cost by contribution. Now contribution minus fixed cost divided by contribution. Contribution is fixed cost means EBIT. Same by contribution. So I can write by 1 by C by EBIT. Contribution. Now we are seeing that contribution plus EBIT, contribution by EBIT means degree of operating leverage. So we can write that margin of safety ratio is equal to 1 by degree of operating leverage. Clear? Now I am giving an example. Suppose that degree of operating leverage is 4, earning before tax is 4 lakhs, interest borrowed capital is 30,000. Find amount of fixed cost and margin of safety ratio. Okay. We are going to solve this problem. Now we are starting with the DOL. Degree of operating leverage is equal to 1 plus fixed cost by EBIT. Now EBIT in your earning before tax, that is 4 lakh, and interest is 30,000. So EBIT in your question it is says 4 lakhs. I interest in borrowed capital it is says 30,000, and degree of operating leverage is 4. So from putting this all the figures, we can calculate the fixed cost. Degree of operating leverage is 4. 1 plus, we don't know the fixed cost, we have to calculate this fixed cost. and we know the EBIT, that is EBIT is equal to, sorry, this is EBIT. This is not the EBIT. In question that is given that earning before taxes is 4 lakh. So earning before tax is equal to 4 lakh. I is there. So EBIT is 4 lakh plus 30,000, or 4 minus 1, that is 3, fixed cost by 4 lakh 30,000, or fixed cost is that is 4 lakh 30,000 divided by 3, that means 12 lakh 90,000 is the fixed cost. Similarly, this is the question number A, and B is also they have asked for margin of safety. Margin of safety is 1 by DOL. So that is 1 by 4. That means 25%. This is the answer. Okay. Now, this is the operating leverage we have learned so far. Next, we are going in the financial leverage. What is the financial leverage? Basically, financial leverage means that you use the debt in the capital structure more and your earning per share will be high. That is called the financial leverage. How if you increase the debt in a capital structure, then your earning per share will be also be rising high. So meaning of financial leverage is the firm's ability to use financial charges to magnify the effects of changes in EBIT on its EPS. So degree of financial leverage is the proportionate change in EPS by proportionate change in EBIT. So financial leverage also we can write EBIT by EBT, or EBIT by EBT minus preferential dividend into 1 minus T, or EBIT by EBIT minus interest. See, when there is a preference share in the capital structure, we use this one. When there is a capital structure, when there is a preference share in the capital structure, we use this one. And when there is no capital structure, no preference share in the capital structure, then we only use the EBIT by EBT. Why? You can only remember this one, EBIT by EBT minus preference share dividend into 1 minus T. When there is no preference share capital in the capital structure, that means your preference dividend is 0. So you put the preference dividend 0 here, and total this portion is going to be 0. So EBIT by EBT. So if you remember this one, you can do all the sum. EBIT by EBT minus preference dividend by 1 minus T. Now, again, I am showing how you get, from where we get the formula. We says that degree of financial leverage. What is the degree of financial leverage? That is proportionate change in earning per share divided by proportionate change in EBIT. As well as similar way, proportionate change in EBIT means del earning per share divided by earning per share del EBIT by EBIT. That means del earning per share by del EBIT into earning per share by EBIT. What is the formula of EPS? What is the EPS means? Earning per share. That means EBIT, earning before interest and tax. You minus I from that, minus tax, that is 1 minus T, minus preference share dividend, that is DP, divided by N. N means number of shares. That is the formula of EPS. Same types differentiate with respect to EBIT. When we make the differentiate, we use that del EPS by del EBIT. That means EBIT minus I. That we can say that EBIT into 1 minus T, sorry, only one EBIT, not 1 minus T, EBIT by N. That is the differentiate. And dp by n is a fixed term, so it will be 0. So del EPS by del EBIT is equal to 1 minus T by N. Similarly, this del EBIT and del EPT, we put this one, del EBIT by del EBIT, we put this one in here. So 1 minus T by N into earning per share by EBIT. Now I am going on the next slide. So what we get? We get del EBIT, del EPS by del EBIT. We put the value, we put the del EBIT by DBIT is equal to 1 minus T by N. Putting this value, we get degree of operating leverage is equal to 1 minus T by N into earning per share by EBIT. Now, 1 minus T by N, again earning per share, sorry, into, again earning per share means EBIT minus I into 1 minus T minus preference dividend divided by N by EBIT. N and N cancel. So 1 minus T into EBIT divided by, this 1 minus T is going downside. So EBIT minus I into 1 minus T minus preference share dividend divided by 1 minus T. Now this 1 minus T is coming this side. So EBIT minus I into 1 minus T minus DP by 1 minus T. This 1 minus T is coming this way. So finally we can write this way, EBIT minus I into 1 minus T, 1 minus T, 1 minus T is set off. EBIT minus I minus DP by 1 minus T. So see, we get the same formula from the degree of operating leverage. So the financial leverage, when there is a when there is a preference share, we use the second one. That means EBIT, EBT minus preference share dividend into 1 minus T. And if there is no preference share, we can write EBIT by profit before by earning before tax. Now, what is the characteristic of financial leverage? Financial leverage based on capital structure, whereas operating leverage is based on cost structure. High debt means high financial leverage, means high earning per share. Suppose I am saying that degree of financial leverage is 5. That means 1% increase in EBIT, there is a 5% increase in earning per share. When there is no debt, we can say that DFL is equal to 1. That means no financial leverage. So minimum financial leverage, again, minimum financial leverage is 1. It cannot be negative. And in practical example, the SBI Life Insurance Company has no debt. For practically SBI Life Insurance Finance, that degree of financial leverage is 1. And high financial leverage means there is a high degree of risk. That means high change, little change in EBIT, there is a more change in EPS. That's why the financial leverage is also called the double edging sword. Double edging sword means when you increase the debt in the capital structure, your financial leverage is also be high, and also when your financial leverage is also high, you can earn the more EPS. That is the benefit of the financial leverage. So if you increase your debt, your EPS will be high. Similarly, when your EPS will also be high, you are coming with the most volatile. You cannot be able, after sometimes you cannot be able to pay the debt. So your volatility will also be going high. This is a bad effect of the financial leverage. That's why financial leverage is called the double-edged sword. Double-edged sword. Next one. Now we coming in the relation between degree of financial leverage and financial break-even point. Before we going that, we are saying something. What is a financial break-even point? You know that the break-even point. What is the break-even point? Break-even point means where the total cost is equal to total revenue. Now I am asking what is the financial break-even point? I am not asking about the break-even point. I am saying about the financial break-even point. Financial break-even point at the level of EBIT where earning per share is 0. Remember one thing, financial break-even point means that the level of EBIT where earning per share is 0. That is the financial break-even point. Now I am coming the derivation of the financial break-even point formula. Okay. How we derive the financial break-even point. Now, so what I have told to you, financial break-even point. That means the level of EBIT where earning per share is equal to 0. We have to find out in which level of EBIT earning per share is 0. So earning per share means EBIT minus I into 1 minus tax rate minus preference share dividend divided by number of shares. Now, what I am saying, we have to calculate this EBIT level. We have to calculate this EBIT with when earning per share is equal to 0. So it means it is equal to 0. So EBIT minus I into 1 minus t minus preference share dividend is 0 because n into 0 is equal to 0. So EBIT minus I into 1 minus t. This preference share dividend is going on the right hand side, so it will be positive. There it is negative, so it will go in the sign change, it will be positive. So EBIT minus I into 1 minus t is preference share dividend. So EBIT minus I is equal to preference share dividend by 1 minus t. So we have to find out what is the EBIT. EBIT is equal to, this I is going on the right hand side, is equal to I plus preferential dividend by 1 minus t. That is the formula of the EBIT. EBIT is equal to I interest on fixed interest bearing securities plus preferential dividend by 1 minus t. Now we going on the our slides. So similarly, see, financial break-even point is I plus preferential dividend by 1 minus t. Now we are coming in the financial, we have cleared the financial break-even point. What is the financial break-even point? At the level of EBIT where earning per share is 0. Now we are coming at the margin of safety, financial margin of safety. Not I am saying about the margin of safety. Margin of safety, you know that the actual level of sales minus break-even point sales, we know the margin of safety. What is the financial margin of safety? Actual level of EBIT minus financial break-even point is called the margin of safety. Similarly, margin of safety ratio is financial margin of safety. That means actual level of EBIT minus financial break-even point divided by actual level of EBIT. As well as operating leverage is the inverse relation of the margin of safety. Of degree of operating leverage is equal to 1 by degree of operating leverage is equal to 1 by margin of safety. Similarly, degree of financial leverage is equal to 1 by financial margin of safety. Now, there is a problem we have given. We have to going to solve this. R Limited has a capital structure consisting of rupees 4 lakhs in the form of equity shares of rupees 100 each. Number 2, 2 lakh in form of 12% preference share. Number 3, rupees 6 lakh in the form of 10% debentures. And number 4, 2 lakh as retained earnings. The company's EBIT is 7 lakh 20,000. Assuming the corporate tax is 60%. So calculate financial break-even point, financial margin of safety, financial margin of safety ratio, and degree of financial leverage. So first we calculate the financial break-even point. What is the financial break-even point? I plus preference share dividend divided by 1 minus tax rate. Here I is says that there is 6 lakh interest, 6 lakhs into 10%, 10% preference there, 10% debenture is there, and amount is 6 lakhs, so it is 60,000. And what is the preference share dividend? If we go on the see 12% preference share, 2 lakh, 12% preference share. Clear? So 2 lakh into 12%, that is 24,000. So we putting the value on financial break-even point. I means interest 60,000 plus preferential dividend is 24,000. 1 minus tax rate, that means 1 minus 0.5, because it is said that, sorry, tax rate is 0.6, so 1 minus 0.6. 1 minus 0.6 means 0.4. 0.4 means 60,000 plus 24,000. If you calculate, you can calculate it. 60,000 plus 24,000 divided by 0.4. You get financial break-even point is 1,20,000. So a financial break-even point is 1,20,000. Next one, what they have been saying? They have saying that financial margin of safety. Now, the financial margin of safety means actual level of EBIT minus financial break-even point. What is the actual level of EBIT? In the question, they have says that company's EBIT is 7,20,000 minus financial break-even point we have calculated is 1,20,000. So 1,20,000. we get 6 link. Number C, financial margin of safety ratio. That means financial margin of safety divided by actual level of EBIT. That is 6 lakh divided by 7,20,000. We will get 5 by 6. Number D, degree of financial leverage. One by financial margin of safety ratio. So 1 by 5 by 6. So it is 6 by 5, or we can say that is 0.12, 0.12. This is the degree of financial leverage. Clear for everyone? Now we are also calculate this degree of financial leverage 0.12 in another way. That is with the formula. So preference share is there. So what is the formula of degree of financial leverage? EBIT divided by EBIT minus I minus preferential dividend by 1 minus T. Okay. What is the EBIT? It is given 7,20,000 in your question. Divide by 7,20,000. I is 60,000. So 7,20,000 minus 60,000 minus preferential dividend. We have calculated 24,000. 2 lakh 12%, and 1 minus T tax rate, that is 1 minus 0.6 means 0.4. So 7,20,000 divided by 7,20,000 minus 60,000 minus 24,000 minus 24,000 divided by 0.4 means it is also 60,000. Same figure, 7,20,000 divided by 6 lakh, that is 1 point, sorry, there is a mistake, 6 by 5, that is 6 by 5. That is, see that we have calculated the margin of safety 5 by 6 and degree of operating leverage comes 6 by 5. So 6 by 5 is equal to 1.2. The 6 by 5 means not 1.2 it is. Okay. So we can calculate degree of financial leverage either by 1 by FOMS ratio, or we can calculate directly by this formula. Now, next one. Now we are coming an important term, that is the trading on equity. What is the trading on equity? Trading on equity, basically financial leverage and trading on equity were used interchangeably. Almost both are same. But in 1961, Professor Fund was the first who suggested that there is a difference between that trading on equity and financial leverage. What he says? He says that financial leverage is what is the effect of financial leverage on the earning per share. We have said the final debt is high. That means what is the your earning per share will be high. The effect is coming on the earning per share. But in case of trading on equity, that this effect is coming under the return on equity. That is the difference between financial leverage and that trading on equity. Almost both are same, but if in case of financial leverage, is effect is coming under the EPS, on the changes of EBIT, where is the financial structure proportionate of long-term debt, preferential capital, and owner's equity. And in case of trading on equity, it is impact is coming on the return on equity of changes in capital structure proportions in the given level of EBIT. That is the difference between the financial leverage and trading on equity. What is the formula of trading on equity? Trading on equity is equal to return on equity under existing capital structure divided by return on equity under all equity capital structure. That means what is your return? What is your existing capital structure? Suppose there is a preference share, debenture, there is some equity share. That is the what is return on equity when there is a debenture, preference share, and equity. And what is the return on equity if all the capital is coming under the your equity? That means preference share is converted into equity, debenture is converted in the equity. Then what is the return on equity? The two ratio of that return on equity is called the trading on equity. I am not going on a calculation how you how you coming on that return on equity, trading on return on equity on existing capital structure and return on equity on all equity capital structure. By we can simply remember this one, trading on equity is equal to owner's equity. OE means owner's equity. FCBC means fixed charge bearing capital, and owner's equity by degree of financial leverage. Now we are going on the trading on a problem on trading on equity. It is said that equity share capital 1 lakh shares of rupees 10 each, reserve and surplus 50,000, 10% preference share capital 500 shares 50,000, that means rupees 10 each, 12% debenture 1 lakh 50,000, total capital is 3 lakh 50,000. If we add 1 lakh 50,000, 50,000 and 1 lakh 50,000, we get 3 lakh 50,000 as its total capital. Current EBIT is 1 lakh and income tax rate is 50%. What they have been said, calculate degree of financial leverage and trading on equity. So first we are going to calculate the degree of financial leverage. Now from that formula, first we calculate a degree of financial leverage is EBIT minus EBIT minus I minus preference share dividend divided by 1 minus T. Now EBIT, that is given in the question, all is given in your question. I am showing the question once more, that EBIT is given 1 lakh. Next one is I, interest is given 12% debenture 1,50,000. So 1,50,000 into 12%, that is 18,000 is the I. When I get the EBIT, I get the I, preference share dividend 50,000 into 10%, that means 5,000 is the preference DP, and in tax rate is 50%. So we are just putting the value in this format. Now EBIT, that is 1 lakh, EBIT minus I 1 lakh minus 1,50,000 into 12%. I am writing 18,000 directly. 18,000. How you get the I, interest? There is a 1,50,000 debenture at the rate of 12%. 18,000 minus preference share dividend, that is 50,000, 10%. So it is 5,000 by 1 minus tax rate, that means 0.5. 1 minus 50%, that means 0.5. So it will be 10,000. Now 1 lakh divided by 1 lakh minus 18,000 minus 10,000. We get 1 lakh divided by 1 lakh minus 28,000, that means 72,000. 1.389 approximately. That is the degree of financial leverage. So we get degree of financial leverage is 1.389. Now in the second part, I am coming That means trading on equity. What is the formula of trading on equity? Fixed capital, fixed charge bearing capital plus owner's equity divided by owner's equity into 1 by degree of financial leverage. Now, fixed charge bearing capital, what is that? Debenture and preference share is in the problem. How much debenture? Debenture is that 1 lakh and preference share is 50,000. So it is 1,50,000. How much is the owner's equity? Owner's equity is equity share capital plus reserve. Sorry, debenture is all 1,50,000 is there. Debenture is 1,50,000. Preference share is 50,000. So it is 1,50,000 by 50,000. That means it is 2 lakh. Equity share. Equity share in the question. How much is the equity share? Equity share is 1 lakh and reserve is 50,000. So 1,50,000. Equity share is 1 lakh and reserve is 50,000. It is 1,50,000. Now, trading on equities is 2 lakh plus owner's equity, that is 1,50,000 divided by 1,50,000 into 1 by degree of financial leverage. That means we have calculated degree of financial leverage 1.389 here, 1.389, and trading on equity is equal to 1.68. See, there is a difference between trading on equity and degree of financial leverage. We cannot say that both are same. Degree of financial 1.389 and trading on equity is 1.68. There is a difference between degree of financial leverage and trading on equity. So we cannot say that all trading on equity, and what is the trading on equity? That is the same as degree of financial leverage. We cannot say that. Now, next is called the EBIT EPS analysis, and the point is indifference point. What is the indifference point? That a level of EBIT where earning per share is same. There is two alternative financial plan where the at the both financial plan where the earning per share is same, at that level of EBIT is called the indifference point. That means at the level of EBIT where for both the plan earning per share will be same, that is called the indifference point. If the expected level of EBIT is greater than indifference point, that means we are using the fixed charges bearing capital in the capital structure, so we get the more earning per share. And if expected level of EBIT is lower than the indifference point, that means we use the equity capital in the capital structure, would be advantageous from the viewpoint of earning per share. What is the EBIT EPS analysis? Now, in x-axis, we measure the EBIT, where the y-axis we are measuring the earning per share. I am saying that first I am saying that there is a two plan of EBIT. One plan of EBIT this way. That is plan, financial plan 1. Another financial plan is there. That is plan 2. Now, we are seeing that at this level, intersect both. That means at this level, earning per share will be same. In which level of earning per share will be same? At this level of EBIT is the earning per share will be same. So this level of EBIT is called the indifference point. At this level of EBIT, earning per share will be same for both the plan. So at this level of EBIT is called the earning per indifference point. Now we go beyond the indifference. Suppose your indifference point is, assume your indifference point is in this. That means at this indifference point, which plan you give the more earning per share to you? Plan 2 than plan 1, because plan 2 is the more EPS. See, plan 2 has the more EPS and plan 1 has the less EPS. So why this benefit has been given to them? This is due to debt advantage. This is due to debt advantage. They are giving more earning per share. And if we coming on this portion, suppose this level of EBIT, see this level of EBIT, earning per share is high on plan 1. See, this is the plan 1. This is the plan 1 is going. So earning per share high is plan 1. Why? Because plan 1 has no debt, whereas plan 2 has the debt. Here is getting the earning per share in plan 2 high. Why? Because plan 2 has the debt. There is debt advantage. In case of plan 1, there is no debt. This portion is called the equity advantage. This is called the equity advantage. This is called the EPS, earning per share, and EBT EPS analysis, and it is also called the indifference point. Graphically, if we tell them that show that graphically, then you have to show that in this way, graphically. So now we come in the problem on EBIT EPS analysis. Suppose problem X, X Limited has two alternative financial plan. Plan 1, 5 lakh, and plan 2, equity share capital is 2,50,000. Equity share 6% debenture, 6% debenture is to 2,50,000. And the expected EBIT level ranges between 20,000 and 50,000. Assuming tax rate at the rate of 50,000, determine the indifference point. No. We are going to solve this problem. No. So what is the formula of EPS? We can route the problem EPS once more. EPS is equal to EBIT minus I into 1 minus T minus preference share dividend divided by number of shares. This is the EPS formula, general formula. Now we are coming in the plan 1. Plan 1, that is, there is 50,000 equity share and there is no debenture. So what is the in both the cases EBIT level is 20,000 to 50,000. So EBIT in plan 1 there is no debenture, so interest is 0. Tax rate is assumed 50%, so 1 minus 0.5, that means 0.5. Obviously there is no preference share dividend, so 0. Divided by number of shares. The number of shares is, we know that is 5,000, because in the question it says that 100 each, equity share capital 100 each. So 5 lakh divided by 100 is 5,000 number of equity shares. So it is 0.5 EBIT divided by 5,000. Now coming in the plan 2. EBIT minus I. Now there is 2,50,000 debt. So 2,50,000 into 6%, that means 15,000. into 0.5. No preferential dividend is there, and number of equity is now, there is only 2,50,000 equity share capital, so it is coming to 2500. So 0.5 EBIT minus 0.5 into 15,000, that means 7500 divided by 2500. So at indifference point means at indifference point, for both the earning per share will be same. So EPS 1 is equal to EPS 2. Now that means both these are equal. This one is equal to this one. So we can write 0.5 EBIT divided by 5,000 is equal to 0.5 EBIT minus 7500 divided by 2500. So if we calculate this one, that means 0.5 EBIT, 2500 and 5,000, it is 2. So 0.5 by 2 is equal to 0.5 EBIT minus 7500. Or calculate this one, multiply this 2 by 2. So 0.5 EBIT, 0.5 into 2 means 1. That means EBIT minus 7500. Or going this one on the right hand side, 0.5 EBIT, EBIT minus 0.5 EBIT, that is 0.5 EBIT, and 7,500 minus, it is coming on right, this is coming on right hand, left hand side. So 7,500. So EBIT is equal to 7500 divided by 0.5. Sorry, there's a wrong. 7,500 into 2, that is 1500, 15,000 that will be. So 15,000 divided by 0.5 is equal to 30,000. So at the level of EBIT, 30,000, at level of 30,000 EBIT, earning per share will be same. So we can write that at EBIT level of 30,000, earning per share of plan 1 and 2 is same. No, what is the sense that in the question they have been told that the expected EBIT level ranges between 20,000 and rupees 50,000. Now that EBIT level is ranges between 20,000 to 50,000. That means we are coming that 30,000. In case of 30,000, earning per share is same. So when EBIT is 20,000, what will be the earning per share? We do three way: 20,000, 1, 30,000, and next 50,000. So when 20,000, earning per share will be 20,000. In case of plan one, so minus interest is 0, 1 minus tax rate 0.5, and there is no preferential dividend, divided by 5,000, it is rupees 2 in plan 1. in plan 1. Now we are coming in plan 2. In plan 2, earning per share is 20,000. There is interest now to 22 lakh 50,000 into 6%. That means 15,000 is the interest. So 15,000 into 0.5, no preferential dividend, and it is 2500. It is earning per share is rupees 1. Now, when EBIT is 50,000. Similarly, in case of plan 1, earning per share, now it is 50,000. 50,000 minus 0 into 0.5 divided by 5,000. It's come to 5. And case of plan 2, earning per share is 50,000 minus 15,000 into 0.5 divided by 2500. It's come to rupees 7. Now you see that at 30,000, both the EPS is same, that is, and in 30,000, what will be EPS? Now, when EBIT is 30,000, so when EBIT is 30,000, plan 1, what is the earning per share? EBIT 30,000 minus preferential dividend 0, tax rate 0.5, there is no preference dividend, so it is 0, divided by 5,000. That is rupees 3. We do not calculate in the second one. We know that in case of plan 2, in case EPS is also rupees 3. Now, if we see in the when EBIT is 20,000, that is less than the EBIT level indifference point. What is the indifference point? Indifference point is 30,000. So when EBIT is less than indifference point, you see that plan 1, which is plan 1 EPS is more and plan 2 EPS is low. Plan 2 1 is EPS is 2. Why plan 2 plan 1 EPS is high? Because plan 1 is enjoying the equity benefit. And similarly, when we go on the beyond the indifference point, that is 50,000, plan 1 earning per share is rupees 5, whereas plan 2 EPS is more than the plan 1, that is 7. Why plan 2 EPS is more? Because plan 2 is enjoying the debt benefit. That's why EPS is more in plan 2. And in case of indifference point 30,000, both the earning per share is same, rupees 3. Clear? Now we coming on the, again we analyze in the paper presentation. Now we come in here a degree of combined leverage. We know that the simple format is degree of combined leverage DOL into DFL. That means degree of operating leverage into degree of financial leverage. That is we know that degree of operating leverage is percentage change in EBIT divided by percentage change in sales, and degree of financial leverage is percentage change in EPS divided by percentage change in EBIT. Percentage change in sales, percentage in EBIT, and percentage in EBIT in both the numerator and denominator. So these are set of, so percentage change in EBS divided by percentage change in sales. So we can write down the degree of combined leverage is percentage change in EPS divided by percentage change in sales. Now we are doing a problem. See, it is a 2008 Calcutta University problem. Relevant information about 3 companies are given below. Annual production capacity, Bill, Peel and Mill, 3 companies are there. Annual production capacity 1,50,000 and 2,50,000. Capacity utilization of cells 75%, 75%, 75%. There's 3 companies are utilized 75% of its capacity. Unit selling price is 40, 50 and 50. Unit variable cost is 15, 15 and 20. Fixed cost per annum 2 lakh, 3 lakh, 5 lakh. Equity capital 5 lakh, 7 lakh, 10 lakh. 10% preferential capital 50,000, 1 lakh. and 15% debenture is 1 lakh, 2 lakh, and 3 lakh. What we have to calculate? We have to calculate operating leverage, financial leverage, and combined leverage. One thing before going on this problem, remember this one very important for both in your financial leverage and in the problem of capital structure. This is the format we generally do: sales in unit, selling price per unit, 1 into 2, we get the total sales minus variable cost, sales minus variable cost, we get the contribution, from contribution minus fixed cost, we get the profit, that is called EBIT or operating profit, both are same, minus interest, we get earning before tax, that may be also called profit before tax, minus tax, we get profit after tax, minus preference share dividend, we get earning available to equity shareholder, number of equity shareholders, divided 1 and 2, we get earning per share. So earning per share is earning available to equity shareholder divided by number of equity. This format is very important in your leverage problems, and also the capital structure problem. Now we are going to solve the problem. See, there are 3 units has been called: mill, peel, and mill. Use the scale in your exam. So come in the annual production. In unit, it is 1 lakh, 1,50,000, and it is 2 lakh. Number 2, sales unit, 75 sales in unit, that is 75,000. 1,12,500 and 1,87,500. How we get this figure? That is 2 lakh. 2,25,000. 2,25,000 into 75%, 1,50,000 into 75%, and 1 lakh into 75%. That is at the rate of 75%. So annual production and 75%, we get the sales unit. Now sell price per unit, that is 40, 50, and 50. So now we come total sales 75,000 into 40, that is 30 lakh. 1,12,500 into 50, that is 56 lakh 25,000, and 1,87,500 into 50, it is 93 lakh 75,000. Sales minus variable cost, variable cost is at the rate of rupees 15. So unit into rupees 15. So 75,000 into 15, we get 1125 000. 1,12,500 into 15, we get 16,87,500, and 1,87,500 into 15, we get 37,50,000. Sales minus variable cost, what we get? We get the contribution. Contribution is 18,75,000. This is minus. It is 39,37,500, and it is 56,25,000. Contribution minus fixed cost. Fixed cost is same for all the firm. That is 2 lakh. Sorry, for field 3 lakh, in this for 5 lakh. Given in your question. We get the operating profit or EBIT. That is 60,75,000. It is 36,37,500. It is 51,25,000. We get the EBIT minus interest 15,000, 30,000, and 45,000. EBIT minus I, we get earning before tax. It is 60,60,000. It is 36,07,500. It is 50,80,000. Minus tax. In the question, it is silent about the tax, but we have to assume, it is tax at the rate of 50%. So it is 8,30,000. It is 18,03,750, and it is 25,40,000. We get profit after tax, that is 80,30,000, 18,03,750, and it is 25,40,000. Minus preference share dividend, nil. It is 50,000, and it is 10,000. Now we get earning available to equity shareholder. It is 8,30,000. It is 17,98,750, and it is 25,30,000. Number of equity share, it is 10,000. For all the, it is 10,000. So earning per share, now earning available to equity shareholder divided by number of equity share, it is 83. It is 179.87, and we can say 253. See, debt is high in M. That's why its earning per share is also be high. Debt, their debt is very low in the bill, so its earning per share is also be low, 83 only. Now, also we calculate the leverage. So degree of operating leverage, contribution by EBIT. See, what is the contribution for B? Contribution is 18,75,000 divided by EBIT by EB contribution by EBIT. So 18,75,000 divided by 16,75,000. These two. For degree operating leverage, contribution divided by EBIT. Contribution by EBIT, it is 1.1194. Similarly, for P, it is 39 lakh 37,500 by 36 lakh 37,500. We get 1.0825, and for mill it is 1.0976. Now, degree of financial leverage, EBIT by EBT minus preferential dividend by 1 minus T. In case of bill, this is the EBIT, 16,75,000, but there is no preferential dividend. There is no preferential dividend, so 1,65,000 divided by EBT, 16,60,000. This is, we get this is 16,75,000 divided by 16,60,000. We get 1.0090. In case of P, 36,37,500 divided by 36,07,500 minus preferential dividend is there, that is 50,000 divided by 1 minus point P, 1.0945. And case of mill, it is 1.0128. This is the degree of financial leverage, and degree of combined leverage, just DOL into DFL. We get 1.1295, 1.0945, and this is 1.1117. So, hope you will understand the leverage, and if you have any problem or any doubt, you can ask me. If you have any problem or you can ask me.
I don't think, sir, there is any problem for students in understanding the leverage after your clear explanation. Okay.
Okay. Okay.
So thank you so much, sir, for your lucid explanation on leverage with multiple examples. And I hope it will help undergraduate students a lot, and it will improve their conceptual knowledge on leverage. Thank you so much, sir. Thank you so much for bearing time out of your busy schedule.
Okay.
Oh,
Welcome.
okay, sir. Thank you so much, sir. Anything else you want to say?
No, no, thank you.
Thank you so much, sir. So,
Then I am
can
leaving.
we end?